Hello and welcome to the iTraders report. This is for the March the 8th 2009, and it's really a follow-up to the payroll numbers on Friday. And what I'm really trying to do here is look at various asset classes and see whether there's an opportunity that, based on this report, there could be some significant turning points in certain markets. This has relevance for short-term traders as well as the strategic trader, and there's quite a few things happening all at once. First thing is the S&P is at a long-term distribution point and is also oversold, and other stock markets are already oversold or have been oversold in the more recent past up to the daily charts, which is relatively a rare occurrence. We looked at bond markets in the pre-payroll report, and we can have a look at where what levels they've gone to post the numbers. And quite interestingly, I had a look at crude oil, not something I've been trading actively over the last couple of months or so. I think the last trade was right at the beginning of the year. But that suddenly got a very interesting setup. If we're looking for people who want to take less risk or want to be a bit more relaxed about their positions, then there are some correlation plays associated with dollar Canada in connection with the S&P. Interesting setup on gold. But very important that we manipulate data. And then finally, linking back to crude oil, I looked at some individual stocks, and there's one or two that are very, very interesting, primarily Shell and Chevron. First of all, we're going to look at the stock markets and really quantify how they're oversold, and the way that iTraders do this is via the case peak oscillator, which is available from casestatware.com. As far as I'm concerned, this is the only true measurement of overbought and oversold. And details on how this study can work are available on some of the educational parts of the website. For those new to it, all we're really interested in is when that green histogram has gone beyond the red line, which is 2 standard deviations of its own momentum. And on the S&P, we've gone beyond it here, and so we are in an oversold scenario, and what we have to do is wait for that to be confirmed. Also, we had a long-legged doji. Dojis are the only pattern from a candlestick point of view that I really take a lot of notice of. And we also hit just about 2 down on the range deviation pivots, and we hit 1 up. So some concepts of momentum drying up. If we look 2 days previously, we did actually manage to go above 3 up, although we couldn't close above it. So there's been some instances where momentum is drying up, as it were. Here's an example of what is a peak out. So here, this is the DAX, and we already have had that purple line which confirms the peak out in the oversold scenario. And this has also fulfilled the criteria associated with Cynthia's study that the trend cycle, after we have been oversold, has reached one of its downside targets. And this is to say that this is the low, or subsequent to that peak out, there is one more low in this cycle. And that's what's happened. It's the same situation for the Euro stocks and the Dow. Interesting on the Dow that we managed to hit 2 up on a range deviation and only hit 1 down, so that was showing some strength as well. And then on the FTSE, the peak out has actually been confirmed on Friday, and interestingly, we haven't really made fresh lows after Monday this week. So some instances where we hit 3 down on Thursday, held the market perfectly. Again, we've hit 2 up and only 1 up. So there's lots of things there that's telling us that not only is momentum drying up, we're actually getting more positive patterns than negative patterns. When looking at concepts of overbought and oversold, and also patterns associated with range deviation, we can connect these up with long-term or short-term market profile supports and resistances. This is the S&P on the daily continuation. And this is going all the way back to the lows of January 1995, and this is the current price close on Friday. And price just dipped in to a previous distribution. So we went down to about 666, and so it's dipped into this area, and then it's reversed back out. The interesting thing is that the speed of the fall, and also looking at the long-term picture, means that we're very much in what's called a long-term vacuum. We could easily rally up to 707, as high as 732, without really changing the very nature of the very big picture. The concepts of where the real breakdown point occurred at 785 and especially 807 is still valid. So we could rally a considerable distance, and the bigger picture could still be bearish. If we look at the FTSE, we have to go even further back to 1993, and price has gone below a distribution low around 35.90, and this is a very, very important level in the short term. And we are a little bit in a vacuum, so there is room for further falls if we don't get a decent rally. The reference point is 35.90, and again, because of the speed of the fall, then we could rally a good 300-400 points and still be bearish. The DAX is also very interesting in that we've really traded into a vacuum point this week, and the distribution low was around 36.75, so we've dipped into it and rejected it, and so far closed just above it. So we have a definite point of reference in the lows of this week, and if the market has made a turning point, it certainly shouldn't take those lows out. If it does, it has plenty of room to fall further. The only market that's not really at a very interesting point is actually the Dow itself. We've made a low of 64.70, which really isn't a reference point going back to January 96. The real key levels are up at around just above 7,000. But again, it shows an example of where we could rally a decent amount. Now we move on to the bond markets. We talked on Thursday specifically about bunds and T-bonds and about how the rollover was negative. Now we had a very strong rally on Thursday, and we went above that 24.25 to 45 point. Note that 24.45 was the low on Friday. This comes back to that control point. If I just move the chart across, we can see the control from the previous trend at 24.40, and that proves to be the low on the day of the rollover. However, in spite of what was a pretty awful report, all that simply happened was the market has gone up to the control of the March contract, so at 25.40 to 45, and so far has failed. And so from a strategic and a short-term point of view, that's a very firm point of reference. If we're going to maintain a bearish stance, then it really shouldn't trade or hold above that level, or especially 125.60. So there are some opportunities there. Trading back below 124.16 would be the catalyst to say that we're effectively opening a huge vacuum point and could get a very swift fall. We also talked about T-bonds and how 125.07 was pretty important, and when I did the video, then we were actually below it. Interesting to see that that proved to be the low on the Thursday. When the pit opened, we rallied very strongly, but then post payroll, all we have simply done is top out at the distribution high around 127.31 to 127.26. So again, in spite of a bullish report, we actually ended up down on the day, and again we have a very, very firm reference about where, if the market is bullish, what levels it has to breach. In terms of being bearish, it's got to, not surprisingly, get back below control and then start trading below 123. Now we move on to oil, and this is a very interesting chart in that I'm looking at the daily continuation of that market. Apologies there, we're just looking at the wrong chart. That was the daily continuation of copper, which we're going to have a brief look at. This is crude on a 60-minute continuation. It's going back to the highs all the way of June last year. The interesting thing, in a very similar way to what we looked at in dollar Swiss and dollar yen a couple of weeks ago, is the distribution is very, very bottom heavy, and so control was right at the bottom of the trend around 42 even. The interesting thing on the current trend, taking from the lows, is that Friday saw control suddenly move from the lows to the highs. Changes in control are often timing points for accelerations or changes of trend, especially if we're not overbought, which crude is not at present. The key thing is the fact that really, because we fell so fast, we now have the ability to rally very fast. There's no meaningful resistance at all until we get all the way up until possibly about $80. I'm not saying that that's where we're going to go, but it just highlights how resistances are light, and so the market could just use supports as reference points as the trend continues upwards. Key levels, certainly at control here, we don't want to be trading below 43.35 or 41.50 control.